Hello, everybody. It is December 19th, and we are going to look at what happened in the market yesterday, Wednesday, December 18th, and the FOMC. Were you left scratching your head and wondering about what's going on in the market and listening to people that give you a narrative on yesterday? Have you been with us long enough to remember last year in December and what caused that move? My kids understand that Santa comes each year and he'll bring different toys. Same person comes, different toys. And we had that same thing play out, except last year, Jerome Claus brought something different. This year, he brought a different message, but it doesn't change the market. So today we're going to look at three aspects that factored into yesterday and what to watch for as we move forward. The ball underwater, where are we compared to our line in the sand, and following the money and the flows. And if any of you remember, in terms of the headlines or the truth, Volkswagen had talked about having clean diesel. And then they faced a huge lawsuit over those false claims. And you want to follow the hard facts, the money, the truth behind it, not the narrative and the marketing. So you're getting a lot of information from others that are trying to make a narrative out of what happened. We're going to show you the mechanics of what's going on. So as we dive in here, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So we'll start with Isaac Newton and his law of motion. And if you've ever been in a swimming pool, this is where we're going to tie in our ball underwater. Isaac Newton said, for every action, there is an equal but opposite reaction. And this was said in similar ways by Richard Wyckoff. Every significant price move is preceded by a period of accumulation and distribution. And I like the quote that he has up here. There are those who think they're studying the market when what they're really doing is studying what someone has said about the market. So we are going to cut through the narratives and get into the facts of what's happening. And on the right-hand side here, we have a chart of the VIX futures, and all that we're doing is holding our ball underwater and then letting it go. So what happens when you're in a pool and you try to pass a ball underwater to a friend? Might be slippery, they hold it down. Pass it to another, and that can continue on. But as soon as somebody lets it go, it shoots up out of the water. And that's what we're seeing happen with the VIX. As we came into September and the VIX expiration, we went down and then went down into that expiration. Once that expiration was over, the VIX repriced. Same thing happened in October, and we repriced heading into the election. Everybody was scared about the market as we were heading into the election. And there was a lot of uncertainty in the market. But when these events are known, it's just like at your house. If you have a squeaky door at night, it can be scary to kids hearing the sound, not knowing where it's come from. But during the day, it's just another annoying noise as you can actually see where it's coming from. And so after the election, that fear was gone. And we held the ball underwater until our VIX expiration yesterday. And notice we're getting an equal move down, opposite reaction, equal move down, opposite reaction. And this is just the big washing machine that we've told you to pay attention to for the last several weeks and months. FOMC mentioned they were potentially slowing rates. And was that really that far out of the picture? They've been talking, and there have been narratives going all along that the Fed may not cut rates, they may slow them down. This wasn't that far out of the picture and doesn't mean that a lot has changed. What did change was the positioning in the market. And we've told you for weeks that commercials have been net short on our SPX. And on the NASDAQ, we were hitting a new max short position this week. And we had shown that on our video. And again, we were breaking that 45,000 mark, which is key. Now, we didn't have the open interest we've had in the past, but when we had 45,000 on the long side, take a look back at what's happened since February of 2014 or 2023. We've gone straight up. What happened to start the year when we were negative 45,000 contracts? The market went down and gave room for some of that position to be covered. What happened now on this 45,000? We went up on Monday, and then we came right down into our levels. This is our chart of the NASDAQ. And all we did was came right down to our lower target that we gave you on our video over this past weekend. And so what's our biggest risk event that was this week was the FOMC. But what gets left behind, just like Christmas spirit, is the VIX. Most people don't pay attention to that VIX expiration cycle. And the fact is, at the end of the year, especially, that's where all the protection is sitting for the end of the year. So people will rehedge a year or more out and they will trade on that yearly expiration cycle. And so when everybody had to reposition against too low of volatility and too low of premiums, that premium had to rise for it to be attractive for traders to sell. And so when that contract expires, we reposition at higher prices. When that VIX rises, we get the big drop in our market. And the same thing happened during Trump's first term with Volmageddon, when we had our lowest realized historic volatility in 2017, but eventually an equal but opposite reaction, the cause and effect from Wyckoff, and we had Volmageddon and a very large move in the markets to the downside, and the largest move we'd seen in the VIX for several years up to that point. And this is also the same thing that happened in December last year, April of this year, and late July and early August of this year. And as we go through the market, we always talk about our line in the sand. And we have two risk environments that we pay attention to. Angry grandpa and smothering grandma. Lately, we've been hanging out at grandma's house. We've been getting cookies, getting to watch TV, getting presents, and being complacent. Yesterday was the first time since October that grandpa got mad and made us do some chores. And we told you in the morning that that 6111 level was our key level. That's where Chicago was going to come in and defend. That defense failed at 205 yesterday. But all week, every time we came to that level, we were holding it. And that's our big signal. And we monitor where this changes every day. But that was our big signal that the market was going to change, because everything in the market changes when we get above or below our line in the sand. And if you're unsure how that works, feel free to check out our Discord or our courses if you want to learn how to apply this on your day-to-day trading. And so when we broke that, that was at 205. That was before Powell even came out to speak. So his press conference really wasn't the narrative to follow. It was just the business being conducted in the stock market. And if you traded in April this year, August this year, October from this year, you'll start noticing that the price action was the same. The narrative doesn't matter. The business cycle does. And so we can dive in now to some similarities and differences as to what's been happening. And were you scared when the market went down in April? And we told you in March that it was likely going to happen. At the same time, and we said this on our videos these past couple of weeks, fund managers ran out of money to buy. They were now going to have to start trading on margin. And if there's nobody left to buy, we can't continue to increase prices. And then we make our move lower. And once we break our line in the sand, the market changes fundamentally and characteristically. And that's what we need to watch as day traders. So once this reverses back, which we won't spend more than a few weeks here, the bull market will continue. This is the same thing we saw between February and March of 2020 during the COVID crash, the options expiration cycle. And all we did was change our risk environments. And once we got back, the bull market resumed. And that's a recurring piece that we saw again, July and August this year, October into November of this year. Nothing has characteristically changed from a fundamental standpoint. And again, on this line in the sand, if we get over or break that, we will see price action changes, harmonic rotations change, market profiles change, directionality, the size of the day's range, and the VIX all change. That's why we mention this when it comes into play for our morning preps and our weekly videos. So if you aren't more prepared than everyone else in the market and you're waiting on a narrative, then we probably aren't the room for you. But if you want to learn how to see the market as a business and understand the inner workings, how to apply them and be ahead of the curve, be able to pivot faster than others, then check out our upcoming courses and you can see what our past students are saying as well. And so now the last thing we want to look into, the third aspect, is following the flows and following where the money is. So has anything changed to the Mag 7 stocks? No. Tesla is still the proxy for the Trump administration bet. NVIDIA is still the proxy and the leader of the AI trade and that sentiment. And the others are highly liquid names that the large money goes to because it's easily accessible. They can put a lot of money in there without moving the market. They can take it out of there, and those haven't changed. Has anything changed in terms of interest rates? Well, last year when Powell spoke, Traders were betting on 6 rate cuts for the year, with the first being in March 2024 with a near 90% certainty. And I remember March, and that didn't happen. It shook out the weekends, though, but never changed the market. And that trade has been wrong more than 70% of the time in the last year. And the market still rallied even in the face of higher interest rates. And so if we think of the deflation and inflation aspects, it doesn't take very far to look. We can look at the Japanese stock market and their asset prices. And when they face their worst deflationary period, where commercial real estate and private real estate dropped 70 to 80%, their stock market dropped for 23 years. Now their currency is getting deflated against the dollar, and it keeps dropping and dropping until the central bank intervenes. At the same time, we are in an inflationary period and prices rise. We get some black swan events, which we'll dive into here in a minute, and then we get our reaccumulation, equal but opposite reactions, cause and effect from Wyckoff, and then we've continued our move up. And these green arrows here are those VIX expirations from last year when we made our move down, and now this year. Similar structure, all time, nearing all-time highs. That day becomes a big day at the end of the year. And if we also think of following where the money goes, everybody wants to know WIIFM, what's in it for me? And you can even look back to Elon Musk. In the early days of Tesla, he would promote tax credits and efficiency and energy, and voting, as he previously described himself, as voting overwhelmingly for Democrats. But now that there's competition in his world with other EVs, he benefits from no tax credits, as Tesla has, for one, mostly phased out of qualifying for those, and two, can weather not having those. But his competitors, they can't stay in business without those tax credits. It's too expensive to produce the cars. So it benefits him now to stand on the other side of the aisle and try to get those removed, along with unnecessary spending that no longer benefits him. So it's the what's in it for me. So let's dive into the market from the commercial side of what's in it for me. December of 2023, March 27th of 2024, July 3rd of 2024, and this past week, all times when fund managers ran out of cash and would have to start buying on margin for their clients, which becomes extra risky. You're leveraging your own clients' money, and some funds can't do that because they may not be approved. Others may take the chance, and doesn't always work out well because you're running out of the capital to buy. You have to leverage something. Once something turns, you're out of luck. So each time, each of these instances preceded a significant drop in the market. So we had our July move down into August. We had our April move down, and now we're making our move down this week, and we moved down to start the beginning of the year last year. This is why we pay attention to the positioning. The narrative doesn't matter. The money in the market does. In October of 2022, the market bottomed because their fund managers had more than 75% of their cash on the sidelines. They had plenty they could go and buy. But at these peaks, when we are out of money, when there's nothing left to be bought, when the commercials can't sell anymore, when there's nothing left in it for me as a commercial sell side trader, well, then I just bring the market down. So other similarities, December 2023 and 2024 had similar drops on the ball underwater phenomenon. The difference was Powell spoke 1 week before last year's VIX expiration, and traders began betting on too many rate cuts. Now they're pulling those bets. Again, they've been wrong 70% of the time on this, and the market still rallied. This year, he spoke on the same day as the VIX expiration. So last year, we were looking for it in the afternoon. We got it. This year, we had to wait for FOMC to get that same thing, and we had to watch our line in the sand. And so remember, as we go into 2025, Trump's policies are being stated by economists to be inflationary. And while that may be bad for us as individual consumers, the market says that inflation is much better than deflation. And so we are going to watch for these prices and our line in the sand to recover. And as they do, you will see that this wasn't as scary as that squeaky door in the dark. Maybe in the next month, we find out that the government was buying jobs under Biden at a faster rate than they did before the global financial collapse under Bush, in the same political playbook. That may change things, but until the unemployment rate rises and changes the flows in the market as people stop putting money into the market out of their paychecks each month or bi-weekly, whatever that frequency is, or until people have a reason to invest in a different country other than the US, the flows support that this is not a longer term change. Now, from our COT report as well, we mentioned that commercials were net short. And as we say time and time again, the house will always win in the end. Yesterday was collection day. They held that ball underwater just long enough to make people feel 10 feet tall and bulletproof before letting the ball out from underwater and creating some waves in the process. So, what's in it for me from the sell side? Push asset prices up, and I can sell and put money in my bank. Then, once I'm shorting into the market, as we see on the COT report, we drop the market and now cover that position, making money there as well as restocking our shelves. This is the what's in it for me that we want to pay attention to. And the sell side is making money on the way up and recollecting those shares on the way down, while retail, on the other hand, can't see past the headline and the narratives being pushed by gurus and furus out there. And why we keep falling into the washing machine again and again. The real risks to the markets lie in the black swan events. Known events, even if they're considered bad, have too much positioning in them to really have much longer lasting effects. When we had COVID, we had a month of decline, and then it took a few months to recover, but that was a black swan event. Russia invading Ukraine was a black swan event. Israel and Hamas conflict was a black swan event. Those are ones that people can't position for. So when those come up, people rush in to get positioned. Otherwise, people are already positioning for these known events ahead of time, and it's just the business being carried out. Remember, at the end of the day, this is a business, and unfortunately, as retail, we are playing both sides of the coin, supplier and consumer. We are buying as it goes up, and then as it drops, we end up being the supply that the commercials can rebuy. The only question you really have to ask yourself every day is, which side do you want to play on? And that's where we use our line in the sand to know which way is best, which direction is most likely, and understand when that changed so we know how to reposition ourselves faster than everybody else in the market. So make sure you guys stay safe out there trading this next couple of weeks. We'll continue to put out the videos and let you know where that line in the sand is, but this is not yet the time for full panic.